Welcome to the Ontario Mortgage and Real Estate Insights podcast, your go-to source for the latest developments, trends, and regulatory changes in the industry. I'm your host, I'm Sandy, your guest host from Keller Williams Legacies here, to provide you with insights sourced from reputable news outlets to help you stay informed.
Steve Hamwin here. This is brought to you by Real Approved Inc., a trusted mortgage brokerage dedicated to helping Canadians achieve their homeownership dreams. Visit realapproved.ca to learn more about how our experienced team can assist you with your mortgage needs. Let's dive into today's episode. Our first topic today, Sandy, is a fascinating development in the digital mortgage space. A company called Pine has reached an impressive milestone, surpassing $1 billion in home loans. This is quite a feat for a digital mortgage company, don't you think?
Absolutely, Steve. It's a testament to how technology is really starting to reshape the homeownership experience. Pine is offering a level of convenience that traditional banks struggle to match. I mean, the ability to apply for a mortgage at 1 a.m. is a game changer for many people with busy schedules.
You're right, Sandy. Justin Herlick, the Chief Executive Officer of Pine, highlighted how their platform is built around the customer's schedule, which is a significant shift from the traditional bank model. By cutting out the middleman, Pine is streamlining the mortgage process through digital solutions, personalized options, and quicker approvals.
And it seems like they're not just focusing on convenience. Herlick mentioned that Pine is currently targeting prime borrowers, but is looking to expand to non-prime users next year. That could open up opportunities for a wider range of homebuyers, don't you think?
Yes, Sandy. It appears they're maintaining a strict underwriting standard, which Herlick claims might even be stricter than some banks due to certain restrictions they have. This approach seems to ensure they have a healthy group of prime customers, and it could potentially expand their market reach in the future.
It's also interesting to see Pine's partnership with Wealthsimple. They're offering a co-branded mortgage product which provides Wealthsimple clients with access to Pine's digital platform along with cashback rebates. It's a smart move to leverage Wealthsimple's user base and offer additional value.
Exactly. And Herlick emphasized that security is a top priority for Pine. They've built their technology with security in mind from day one, using several identity verification methods to protect against fraud. Given the digital nature of their service, ensuring customer data remains secure is crucial.
That's reassuring for users who might be hesitant about digital mortgages. While they don't meet customers face-to-face, their verification methods seem robust. Plus, their business model of working with banks for funding and securitization ensures they're well integrated into the existing financial ecosystem.
Overall, it seems Pine is on a promising path, combining technological innovation with strategic partnerships and a focus on security. It will be interesting to see how their expansion plans unfold next year. Sandy, let's talk about the recent drop in Canadian bond yields. It's creating a bit of a paradox, isn't it? While it's good news for borrowers because it means cheaper borrowing costs, it's not exactly a positive indicator for the economy.
That's right, Steve. Bond yields have sunk to their lowest point in half a year. This drop is making mortgages more affordable, with competitive lenders already passing on the benefits to consumers. We've seen 3-year uninsured fixed rates drop by 5 basis points to 3.89%, and 5-year uninsured fixed rates down 10 basis points to 3.99%.
Yes, and for those with insured mortgages, the 5-year fixed rates are now down 5 basis points to 3.79%. It's a good time for those looking to secure a mortgage, especially if they're well qualified or live in regions where rates are even more competitive.
Absolutely. In Ontario, for instance, RateBuzz.ca is advertising even lower rates, like a 3.69% 5-year fixed for insured borrowers. But as always, it's important for borrowers to shop around and not just focus on the rates. The fine print, approval times, and the advice you get are just as important.
That's a key point, Sandy. While the lower rates are enticing, one must consider the overall package, including the terms and conditions. It's not just about the numbers on paper. And speaking of numbers, the drop in bond yields isn't necessarily a positive sign for the economy.
Correct. While homeowners might benefit from stable borrowing costs and potential increases in home values, the underlying economic indicators that drive these lower yields could point to economic slowdowns or uncertainties. It's a bit of a double-edged sword.
And there's some optimism in the Greater Toronto Area, with early data showing a 2.7% increase in median home prices in October compared to September. This suggests some pent-up demand and incremental income gains are supporting the housing market, at least for now.
Yes, it's interesting to see that despite the challenges, the housing market is showing resilience. However, as Robert McLister, a mortgage strategist, pointed out, it's crucial for borrowers to remain vigilant and informed about the broader economic context.
Indeed, Sandy. While we're seeing some positive trends for borrowers, the broader economic implications cannot be ignored. We'll have to keep an eye on how these factors evolve in the coming months.
Steve, let's delve into the current condo market situation in the Toronto and Hamilton areas. It seems like the market is facing some significant challenges, with cancellations hitting a record high this year. According to Urbanation, 18 condo projects and 4,040 units have been canceled so far in 2025, and 10 of those were in the third quarter alone. What's your take on this, Steve?
Well, Sandy, it's a clear reflection of the difficult correction the market is undergoing. Sean Hildebrand from Urbanation mentioned that this is following an excessive growth period during the COVID-19 pandemic. It seems like the market is trying to find its footing again, but it's definitely a tough time for developers and buyers alike.
Absolutely, Steve. And it's not just the cancellations that are concerning. Since the start of 2024, 32 projects and nearly 7,000 units have been canceled. Plus, there are 20 more projects on hold, with a high likelihood of cancellation. This is a substantial number, and it certainly puts a strain on the housing supply.
Exactly, Sandy. Financing issues and the inability of pre-construction buyers to close on their units are significant factors here. Developers like Mattamy Homes and QuadReal have had to cancel projects due to low pre-sales. For instance, their redevelopment of Cloverdale Mall was canceled after pre-selling less than 10% of units. It's a tough call, but sometimes it's a necessary business decision.
It's a tough situation, Steve. The new condo market is on track to have its worst sales year in 35 years. Unsold units and completed projects are up 142% from last year, reaching a record high of 2,944 units. And with new condos being significantly more expensive than resales, it's a challenging landscape for buyers.
Yes, Sandy, the cost disparity is quite striking. A resale condo averages $867 per square foot, while a new one is around $1,199. The high costs of materials, labor, and development charges, along with high interest rates, make it tough for developers to lower prices. This economic environment is quite restrictive.
And as construction activity slows, it further exacerbates the supply issue. Only two projects began construction in the third quarter, which is a 77% decline from last year and 88% below the 10-year average. This slowdown could hurt supply in the future, but Sean Hildebrand noted it might also help restart the market by creating a supply crunch.
That's right, Sandy. It's a bit of a silver lining. While the current lack of activity is concerning, it could lead to a more balanced market in a couple of years. But for now, it's crucial for everyone involved to navigate these challenges carefully and to keep an eye on broader economic factors that might influence future developments.
Now, Steve, let's delve into a serious regulatory matter that has recently come to light. The Financial Services Regulatory Authority of Ontario, or FSRA, has imposed significant administrative penalties on two individuals in the mortgage industry. This situation involves Satyamkumar Trivedi and Sasitharan Somasekaram Pillai, both of whom have faced penalties for contravening the Mortgage Brokerages, Lenders, and Administrators Act of 2006, along with its regulations.
That's right, Sandy. The FSRA has levied a total of $180,000 in penalties against Trivedi and $50,000 against Somasekaram Pillai. These penalties were imposed due to their involvement in facilitating dishonesty, fraud, and other illegal activities, as well as conducting business outside of their registered brokerage, which is a clear violation of the regulations.
It's quite concerning, Steve. Trivedi, in particular, was found to have engaged in additional violations such as hindering the FSRA's investigation by concealing information and providing false or misleading information. He was also found to be administering mortgages without the necessary license. These actions are serious breaches of trust in the financial services industry.
Indeed, Sandy. It's crucial for the integrity of the market that such actions are addressed decisively. The FSRA's decision to impose these penalties underscores their commitment to maintaining transparency and accountability within the industry. It also sends a strong message that any form of misconduct will not be tolerated.
Absolutely, Steve. It's important for consumers to have confidence in the regulatory framework that protects them. The FSRA's enforcement actions are a testament to their dedication to safeguarding consumer interests and ensuring that the mortgage industry operates within the legal framework.
As professionals in the field, we must always uphold the highest standards of integrity and ethics. The consequences of not doing so are evident in this case. It's a reminder for everyone involved in the industry to remain vigilant and adhere strictly to the regulations that govern us.
Well said, Steve. It's crucial for all stakeholders, including consumers and professionals, to stay informed about the regulatory environment. By doing so, we can help foster a more transparent and trustworthy industry for everyone involved.
Thanks for tuning in to another episode of the Ontario Mortgage and Real Estate Insights podcast. We hope you found today's insights valuable as you navigate the world of mortgages and real estate.
Before you go, a quick reminder, Real Approved is here to make your mortgage journey smoother. Whether you're buying your first home or refinancing, their experienced team is ready to guide you with personalized support every step of the way. Visit realapproved.ca to get started and take the next step toward achieving your homeownership goals. Catch you next time and stay informed with the latest industry insights.